Hello and welcome. This is a very important weekly update. Reason being, the market is starting to break down. There is one additional factor that I'm waiting for before going really bearish on the market, and we'll talk about that in a moment. But let's have a look at what is actually going on. Let's have a look exactly what's going on under the hood, if you like, of the market, so we can really start to understand how this is likely to play out. Now, margin debt has hit record levels. This topped 822 billion in March. It increased another 1.7% just recently in May. And this doesn't seem like it's going to go or cool off anytime soon. Now, every time we've seen a market crash, it is always when we have a market debt bubble. We are currently at a level that preceded every market crash in the past 30 years. So this is something that is obviously very, very bearish. Whenever we see the margin debt ratio cross 60%, within the next few months, we see a market crash. And this is something we've seen back in 2000, back in 2008. And right now, the margin debt ratio is 71%. Back in 2008, it reached about 62%. So it's above the 2008 level. And in 2000, it was around 85%. So anything above that 60% mark, and we normally see a market crash, or we have done, has played out within the next couple of months. So that's the first warning sign, is the debt margin, or the margin debt, should I say. Now, if you think about this, what is it? Firstly, if someone doesn't understand what it is, it's simply just borrowing money to buy shares. Okay, so maybe, if you want to buy, say, $100 worth of stock, just a silly example, $50 of your own money and $50 of margin debt, borrowed money. So, people are borrowing a lot of money to buy shares, and that's really what's been driving this market up, along with, obviously, quantitative easing, and that's really causing inflation of financial assets. And, we're seeing the markets now starting to cool off, though. So we've got the Delta variant of the coronavirus, which is causing issues with the market. Are we going to have that recovery and all that type of thing? So it's certainly causing some uncertainty right now, along with a lot of other things. And let me explain to you some of the things that are actually going on. Now, the skew, we've been talking about this for a while. It's above 135. Anything above 135, right now 155 is the current reading, shows you that the market is bearish. The smart money is worried about a market crash. Now, the housing price index, that started to move down prior to the 2008 global financial crisis, and then certainly sold off. Could we be seeing that same sort of thing? Well, we would really need to be looking here at lumber and gold, right? The ratio between gold and lumber is very important. Again, this is a sign that we would look for a market crash. If we start to see gold rally, which it has started to, and then lumber continuing to sell off, that's another sign that precedes a market crash. So continue to watch that, as it is starting to unfold right before our eyes. Now, the Warren Buffett indicator is severely overvalued. Okay, so if we look at the total market value of all the US stocks and compare that to the total global or the global total economic output of the United States, I'll get it out eventually, you can see here that that is 234% of GDP. The total economic output of the United States, my goodness me, that is severely overvalued. Anything more than 115% is severely overvalued. Now, I wouldn't look at Warren Buffett's indicator here, which compares the US market value compared to GDP, as a way of timing the market moving down, because it's not very accurate in timing. But what it does is it shows you that, imagine this stock market like an elastic band. The further it gets stretched to the upside, for example, the more sharp the snapback, or the more painful the snapback will be. And it's just a matter of time before this happens. Again, this is not gloom and doom. It's not fear. It is a perfectly normal event in the markets to see a correction or a crash after what has happened, particularly with what is going on, as you'll see in a moment. The number of stocks below their 50-day moving average, above their 50-day moving average, is below 50%. In fact, it's below 25%. My goodness me, this is extremely low right now. So again, this is showing my market momentum is struggling, and this is another sign. It's what you normally see prior to a market crash. The number of stocks well below 50%, right? 50% of the stocks below the 50-day moving average. Now, inflation hitting 13-year highs in June. That's another thing that we see. Inflation certainly in financial assets and in food and a whole range of other things that is going on around the world. So inflation hitting all-time highs, and that is something, or highs for the last 13 years, should I say. And that's something else that we need to be mindful of as well. Corporate share buybacks. This is something that we see prior to a market crash. Record corporate buybacks, and we can see here a 4-week average of share buybacks hit a record of nearly $2 billion. Research from the Bank of America just in the last couple of months. So, a lot of companies buying back their own shares, propping up their share price, and this is something that we see prior to a market crash. Now, another thing that we're seeing right now is banks not being willing to lend money. Now, part of the goal of quantitative easing, which is obviously what the market is hooked on right now, along with stimulus and government intervention and Fed intervention, is part of the QE is there to encourage banks and lending institutions to lend money, right, to increase loans. But what are they doing right now? They're actually cutting back on loans. So cutting back on personal lines of credit with Wells Fargo. That is certainly something that we are seeing right now play out, which is a bit of a strange move given that the banking industry needs to boost loan growth. And that's what the QE is designed to do, increase the amount of loans that are being given out and, stimulate the economy. JP Morgan is hoarding cash, a huge amount of it. Why? Because there's a very good chance that inflation is here to stay. So they've got a huge amount of cash on the sidelines. And you can see here, the bank now expects $52.5 billion in net interest income in 2021, down from $55 billion it disclosed in February. Why? Because it is stockpiling cash. And this is something here where they've lost $2.5 billion. So it's actually costing them money to have money on the sidelines. Why are they doing that? Number of loans. We can see that dramatically starts to move down as we start to see a market crash. We've started to see that already. So we're starting to see banks now really pull back from lending. This is another significant warning sign where banks are not willing to loan out as much money as they did before. And another thing that's happening, like we saw back in September of 2019, where we saw the repo market start to suffer significantly. So what is the repo market? Well, think of it as the world's most important pawn shop, okay? Now, the repo market is not repossession, it's short for repurchase agreement. Okay, so the repo market can be complex, but let's try and keep it as simple as we can. And really what they're doing is they're exchanging cash for treasury securities. Okay, so on one side you've got cash, on one side you've got treasuries. Okay, now what they would normally do is lend out their treasury securities, okay, to other banks and other lending institutions. In exchange for that, they will receive cash. They then want to buy back those treasury securities normally the next day. So they normally just do this overnight. Now, the difference between what they received by selling them and what they paid when they buy them back is the implied interest rate. Okay. Now, back in 2019, September 2019, the interest rate went through the roof, reaching as high as 10%. Why? Because banks stopped lending money to each other. And it really is an important process that keeps the whole market liquid, keeps things moving. So, if banks are not willing to lend money to each other in the repo market overnight, and that starts to dry up, that has a dramatic impact. So you can see here, the New York Fed pledges to offer $1 trillion a day in overnight repo loans. This is back in 2019. There were big problems there. And, this is something that can really cause quite large problems in the overall markets themselves. So, without getting too deep into it, because it can be a bit of a complex subject, if you start to see repo market dry up, where in other words banks are not willing to lend to each other, they're not willing to exchange, that is a huge problem. Obviously, the Federal Reserve would step in with trillions of dollars to stop that having a dramatically negative impact on the market, but it's something that we're starting to see again. And the Fed did halt a huge potential crisis in overnight lending markets. Now, they did that for now, right? Doesn't mean that they've solved the problem. Now, the other thing that we're seeing right now, which is obviously a big problem for the market, is the reverse repo market. Goodness me, Sean, this is getting complex. What does this mean? Well, what's happening right now is normally you would see the Federal Reserve lend money to the banks, and then they would lend money out to the public in the form of loans and credit, and they would actually create more money, right? The money multiplier, right? You have a certain amount of money that you have in reserves, and you can lend, say, 20, 30 times that out as a lending institution. So you actually create money by doing that and put that into the economy. More people spend, more goods and services, so on and so forth. But what the banks are doing now in the reverse repo market is they're actually saying, thanks, Federal Reserve, for the reserves that you've given us here, but we don't want them. You can have them back. Right? So actually giving money back to the Federal Reserve. Now, why would they do that? Well, number one reason is they can see what's happening. They don't want the money, right? The banks don't want the money, and they don't want the counterparty risk. This is something that they don't want, right? Could be the same problem that we saw back in 2019 that I just explained to you. So with the banks now giving the money back to the Federal Reserve, that's a big problem. That could be a big problem here. So we're starting to see some significant cracks in the markets right now. Now, as far as the futures go for today's trading session, they're pretty flat right now, right? Not really telling us a lot. Anything above 1% would be significant. But if we have a look now at the actual charts, right? Always have to look at the actual price. People lie, numbers don't. So if we have a look here at the price, something that I've been telling you guys for a while is to watch this significant trend line. So this trend line here goes all the way back to March of 2020 when we hit the lows after the pandemic first hit the globe. And the market has respected this until just yesterday's price action. Now it's dropped dramatically below that, with the S&P 500 down over 1.5%. So this is a very bearish development. If we see another close below this low here, I will be getting bearish. I have several different strategies to go bearish on the market. That will be a fixed limited risk and unlimited potential upside. So this is how we made significant money in 2020, and we'll be looking to do the same thing if we get another close below this low here. Now, we have our 92% accurate opening range where we set the high and the low of the first trading day of the month, which gives us the bullish if it's above this top line, or bearish if it's below this bottom line here, opening range on the stock market for the next couple of weeks. Until when? The third Friday of the month. So the third Friday of the month was here. Okay, we put the high and the low. That now represents the opening range. We clearly are bullish, but more importantly, below this significant trend line. Now, if we recapture this trend line and continue to move up, we will just continue to play the market to the upside, right? Trade what you see and not what you think. But if we do start to see another close below this prior low here, and still below this trend line, which goes all the way back to March 2020, that is significant. A lot of different institutions are looking at this. This will trigger sell campaigns. This is something that you've got to watch. So we're in bearish opening range right now. Anything below 4322.53 on the SPX is bearish. So if we continue to stay below that and this trend line, another consecutive close below that, I will be starting to position myself to the downside, no doubt about that. Now, high yield bonds is another thing that I've been saying watch, okay? And if we have a look at this with that trend line going back to October, there it is there. We've just broken that as well as the 50-day moving average. That's very bearish. If we look at junk bonds, the risk appetite of the market, that trend line here going back to October, it's closed below that and the 50-day moving average. That's another very bearish sign. If we look here at transports, the transports will tend to lead the market by several weeks. So what does that mean? That means as the transports start to move down, it will take the stock market several weeks to actually catch up and start moving down or moving in the same direction. So we saw this strong uptrend here, even breaking above this upper trend line here. And now we've entered a downtrend, and importantly, last night we closed below that channel here, the lower trend line of this channel, upward channel. So that's very bearish as well. So there's a lot of things here right now that are showing me that this market is starting to show some significant cracks. And we want to be certainly very mindful of that. So going forward, those are the things that I'm watching. If we don't recapture that significant trend line on the SPX in the next day or two and still remain below that opening range in a bearish manner, we will be setting up positions to protect ourselves and also profit significantly from the market correcting or crashing, right? No doubt about that. So there's some of the things that I'm seeing right now. CCL is a position here that we're looking at, and this is one that is in a steep downtrend here. If we have a look here at the chart, we've crossed below the 200-day moving average, bit of a double top there, starting to really sell off. Fair bit of volume coming in here. That could be ending volume, but I think longer term, this still looks pretty bearish. I mean, let's have a look at this on, say, Yahoo Finance, for example. Look at CCL. So if we look at CCL, why is that not going to Yahoo Finance? Let's try it here. Okay, so we have a look at it here, and we go to statistics. All right, it'll bring us to this page. So we can see the operating margin, severely negative. Return on equity, what are the owners getting for their return in the stock? Not much, negative 47%. We have a look at the revenue growth year over year, negative 93%, not looking to flash. The amount of cash they have is significantly less than their total debt. So this is something else that is not a strong sign. They have a lot of institutional investment though, and some insider investment as well, but the actual financials of this particular company are pretty poor, and going forward doesn't look that crash hot. If we have a look down here at the next 5 years, earnings growth estimates, what causes a stock to continue to move up? A company that's growing its earnings. And I just finished presenting with Robert Kiyosaki, and certainly he's very bearish on the market as well. And next 5 years, over 115% to the downside. So pretty weak stock overall in a steep downtrend. And if we go here and we have a look at, say, earnings whispers, for example, no earnings coming out, not confirmed yet until maybe late September. Let's see what they reported last time. Carnival beats. Did they really? Loss of $1.80 per share of revenue. What were they expecting? A loss of $1.68. And revenue of $50 million. And what were they expecting? Revenue of $193.5 million. So I wouldn't say that they beat earnings. That's pretty poor earnings, to be honest. So nothing terribly bullish about this stock. We can set up several positions on this using a whole range of different strategies, right? That will help us make money as this continues to move down, or even if it just stays around that same price. I will still set up strategies that will make us money. So that's certainly one of the stocks that we are looking at. The only thing with the market right now is obviously another consecutive daily close below that trend line and the opening range. But the 50-day moving average, we can see here, come down to the 50-day, bounced. 50-day bounced, bounced, bounced. Is it going to bounce here? This is the only thing that's really saving it right now and stopping me from setting up a whole range of bearish positions. If it does close below the 50-day moving average and then another daily close below, consecutive days closing below the 50, along with everything else I've told you, we will be setting up bearish positions, no doubt about that. We have one there on CCL, but this is, they're starting to get quite serious then, and we could see the market certainly sell off in the short term. So they're the things that I'm looking for right now. We will position ourselves accordingly, and we really are at a turning point in the market right now. However, we do understand that we are just entering earnings season. So we have a whole range of companies that are reporting their earnings, not so much this week. If we move into next week, you can start to see really ramping up, hundreds, over 500 companies reporting in one day. We go into the first week of August and we can see even more, right? Just incredible amount of companies that will be reporting their earnings over the next couple of weeks. So, if we start to see a whole range of companies just absolutely crush their earnings expectations, much higher than what the analysts expected, earnings per share and revenue, that may save this market. But that's the only thing that I can see right now, along with that 50-day moving average. Everything else that I'm looking at is pointing to bearish. So let's see what this week gives us. Let's see if we can rebound with some positive earnings. If not, we will go bearish. And really, with us as option traders, couldn't care less if the market goes up or down. We can make money just as easily in either direction. So let's see what happens this week. Thank you so much for listening. My name's Sean Allison. All the best, and bye for now.